After the attack by Israel on Iran and now a counterattack, stocks fell today while safe haven assets surged. The spike reflects concerns that a broader conflict in the Middle East could lead to significant disruptions in energy. Let's go to Michael Dehal. He's Senior Portfolio Manager with Dehal Investment Partners at Raymond James. Thanks for coming in.
Thank you, Marella.
So let's talk about early reaction, because we saw a lot of very early morning reaction in response to Israel's attack. Was that what you expected?
Yeah, this morning we've seen a spike in commodity prices. Oil spiked, gold, natural gas, safe haven trades like defensive currencies, the US dollar, Japanese yen, the Swiss franc also rallied this morning, and also defense stocks. Also in response to the conflicts in the Middle East, did rally this morning, and a defensive tone in the overall markets that we've seen this morning.
It seemed to calm down fairly fast. Things haven't sort of come back quite, but there was an immediate sort of bounce back early afternoon. Did you expect that or anticipate that?
Yeah, by mid-morning, we've seen a little bit of buy the dip mentality by investors, but then by the afternoon, when Iran sent those missiles back into Israel, we've seen the market sell off quite a bit this afternoon.
Do you see this as short-lived? I'm wondering how you would advise investors at this time.
It's hard to say right now. It's such a fluid situation. For investors, what we're saying is don't panic, stay the course. If you do have cash, it might be a good time to dollar cost average into positions into the markets. But the biggest thing is you do not want to panic. And this thing could easily get resolved over the next week or two, or it can get prolonged, right? But we still don't know at this time right now.
What would you consider the safer haven assets for investors at this point?
Right now, at this point, more defensive, like the healthcare sector. Companies that have a strong financial balance sheet, good cash flows would be more what we'd be tilting our portfolios towards more right now.
Just wondering about healthcare, because it's been fairly flat, right, for so far this year. All the tech stocks have been bouncing back. You've seen financials pretty steady, but healthcare seems to be still depressed. Any idea why that is?
Yeah, it's been a rotation more into growth stocks for the early part of this year. If this conflict does get prolonged, we could start seeing a rotation back into value, such as healthcare. They do exhibit low valuations, low multiples, and a lot of healthcare companies in the pharma and medical device distributor space, they do have good cash flows that can support any downturns in the economy.
What about retail and discretionary? And I ask because we initially at the start of the year thought we were headed for a recession, be it technical recession or a full recession in North America. People have now moved off of that because some of the tariffs have unwound. It's not as risky. Where do you land right now on consumer sort of retail stocks?
I would still avoid consumer discretionary. The soft data that we're seeing coming through, consumer confidence, consumer sentiment, is still pretty depressed right now. Whether that translates into the hard data, whether it's a labor market, although we are starting to see the labor market signs of cracks in there. So I would definitely avoid any consumer discretionary stocks or any retail stocks right now.
What about real estate?
Real estate's it's an interesting sector right now. Real estate with a cautious consumer, real estate is another sector that we would avoid at this time right now. If you look at the U.S., prices are still relatively high. Mortgage rates, the 30-year mortgage is hovering around 7%. So that could have a headwind for the sector.
Okay, so let's talk a little bit more specifically about healthcare. You made a good point of the fact that when things go bad, they usually have money that they're sitting on that they can sort of back things up with. Are there specific healthcare stocks that you like at this point?
The healthcare companies that we do monitor right now is McKesson. McKesson is a U.S. Pharmaceutical distributor. They distribute medical devices, surgical devices globally. They consistently have had double-digit earnings growth over the last number of years. They've been increased their dividends for the last 16 years, and they have a robust cash flow and a share buyback program.
Okay, so McKesson is one that you like. What about in financials?
In financials, so you're seeing in the U.S. Higher interest rates, which translates into higher net interest income for the banks and financial institutions. And over the last few months or so, we're seeing a pickup in M&A activity, IPOs, So those benefit capital markets. So a company in that space would be Goldman Sachs.
Okay, and technology, are you sort of a fan of the Magnificent Seven, or do you like something outside of that group?
In tech, we like NVIDIA. NVIDIA is still the AI infrastructure king. They have a very large moat. They still have about 90% of the market share. Their financial growth has been quite significant over the last couple of years. They're beating on revenue growth and earnings expectations.
Because NVIDIA has had some of its shipments sort of pulled back from China, which we know is a multi-billion-dollar hit for them, and Donald Trump seems to sort of pivot routinely on technology and who can send what where because of concerns about China and Russia. Would you favor NVIDIA and some of the other stocks associated with it moving forward, or is that sort of a concern that would make you watch it more closely and perhaps get out of it?
We still like NVIDIA. They're still getting a lot of good demand from the hyperscalers like Microsoft, Amazon, Google, Meta, right? All those companies use NVIDIA, rely on NVIDIA for the training and training AI models and all that, right? So we still like NVIDIA. Their financials are still robust. They have a monopoly in the industry, although more players are starting to enter that industry. But NVIDIA is still the king of the hill for the semiconductors.
Yeah, they've closed the gap from where they were in April. They've come back fairly well. They've got a little bit of room to go, I believe. But I just want to ask you if you think there is still further growth from them to get past that for the end of the year, because a lot of them pulled their guidance, right, and said we don't know what the year is going to hold.
Yeah, and I think there's still room for them to grow. They're still experiencing double-digit growth on top line and on bottom line earnings per share, right? So I still think there's more room to grow with NVIDIA. They have a healthy balance sheet, a lot of cash on hand, and they're coming with new chips every few months.